every single Tuesday for the past couple months. We've been talking to Ryan Pinnell, the CEO over at Kaiju. Kaiju, very interesting company that's using AI to manage its DIP ETF as well. As you know, just producing a lot of different cool insights and things like that. So without further ado, I'm going to go ahead and bring my man Ryan on. Today, Tuesday, we will be talking about indicators. So the past few weeks, we've talked about, setting up a trading platform, how to get started. Without further ado, let's go ahead and bring my man Ryan on the screen. Ryan, how are we doing today?
Good, Aaron. How you doing? You recovered from your turkey coma?
I'm good. Yeah, it was a coma induced by a few things, turkey and gravy and mashed potatoes being one of them. And yeah, now we're back, and like I said, just ticking along. And I'm excited about our conversation today because I think indicators is one of those things that becomes. I feel like that's the first thing where people kind of start down a similar path with trading. But indicators might be one of the first things where people really start branching off. Once you say, okay, say you and I are both starting, we both paper traded for, if you know a little bit, or we're first starting a paper trade, you might opt toward using, your 5 indicators. I might opt toward using my 5. And that's kind of, I think, where people start personalizing their trading experience.
Yeah, I mean, it's like you're starting out, and the first time you're in some chat room and somebody says, "Oh, I got a Bollinger Band compression here," and you're like, "A what? I don't know what that is." And you look it up, or somebody shares their screen, there's a screenshot, and you see that there's either all this crap layered on the chart or underneath it, and you're wondering what it is. And of course, I think in the beginning everybody thinks that it's going to make a huge difference to profitability. It's like, oh, I'll trade when this crosses over, or when this turns red, or when this turns green, which isn't the case. But like, we all believe that at the beginning. So then there's the search for the best indicator and the best settings. It's like, okay, what's my package going to look like? But yeah, all been down that road.
Yeah, and I mean, I think some people, it's easy, I guess, if you're using indicators and you have success using, your new indicators for the first few times, it's easy, I think, to think, oh, okay, now I figured it out. Now I just need to run these indicators. And since it's got me 1 or 2 winning trades, it's going to continue to do that. But as we know, and as I'm sure we're going to talk about, Ryan, there's no, one specific set of indicators that's going to give you 100% of the time perfect buy and sell signals.
That's right. They're really designed so that you can better see something that's hidden in noisy data. To your point, there's nothing where you can, this cross, that cross, this is green, this value is above X, I'm going. Like, that is just a really, really dangerous way to trade, because you do get false signals. There is noise. You might look back at patterns that include lagging indicators, which have lined up after the fact, and go, oh, every time this thing crosses, it would have been an amazing buy. And then when you try to use it in real time, that doesn't happen. The cross doesn't actually happen at the point where it will show up historically, because you're viewing it with lag built in. So, there's no way to get around that. Nobody trades like that. Not even the AI systems that we build don't do that. They don't look at a million different indicators and go, well, 311 of these lined up, we're a go. There's a lot of different analyses. But that said, they're really helpful in making a trading decision and helping you see whether or not something that you believe to be the case is the case.
100%. Well, Ryan, let's start off, and I guess let's start simple for anyone who, again, might be kind of newer to trading, or this is their first foray into indicators. What is a trading indicator? What is it used for?
So a trading indicator or an analytical indicator is just a visual representation of a relationship between price, time, quantity, themselves, each other, all of the above, some period, etc. It's to help you determine, I always think about it is it's to help you determine the root cause of movement that you're seeing on the price chart. And I always describe it like, you have to think about price is the symptom, right? It's the end result of a collection of market participant behavior. So it's the last thing. It's the last thing that we see. After a huge institution, a collection of institutions, HFTs, retail traders, whatever it is, corporations have decided that they're going to do something. The end result is the price that prints. So if you think about it like an illness, price is the cough. So somebody has a cough, but you don't know what that cough is. Is that a tickle in your throat? Did you eat spicy food? A glass of water went down the wrong way? Do you have a seasonal cold, allergies, COVID, or lung cancer? All of those things present with a cough. There's a very different root cause to the cough. And until you get to that root cause, you can't really meaningfully do anything about it. So that's what indicators help you to do, is determine what's the cause of what you're seeing in price.
Yeah, and so before we, get to what to use, Ryan, let's start with what not to. What are some popularly used indicators that you see a lot of retail traders use that are overused or maybe even should be avoided at all costs?
Yeah, you're teeing me up for this one, Aaron. I think, from some of our conversations in the past, you know where this is going. They're really, from my perspective, it's just my opinion, there are two don'ts. One, do not use like 7 or 8 indicators. Like I've never used, I don't know any professional traders, ours certainly don't use more than 4 or 5, depending on the type of trading that you're doing. If you try to use like 8, 9, 10, 11, and you stack them all on top of each other, you're simply going to create an endless amount of contradiction. Right? Like 4 or 5 will be, yeah, go. You're 100% correct. What you're seeing is valid, and you can feel confident placing this trade. And the other half of them are going to say, yeah, it's the worst idea ever. They simply don't function limitlessly well together. So we'll talk about and show some examples of how you might consider grouping them and which you might use. Please don't use like ever more than 5. And please don't use MACD. If you're using that, that should not be part of your analysis toolkit for multiple reasons. One, it's enormously laggy. So what you're seeing in these crossovers has long occurred. You're way late to the game. 1. 2, we on the institutional side use these crossovers at least the executing traders do, for advantageous printing of entries and exits. So if I give our executing trade desk an instruction to exit a position, like sometime today, okay, we're gonna unload Disney today, whatever. And one of the things they will do is they will look to see if it's close to a MACD crossover on some of the more popular periodization settings. And if it is, they'll just wait until they get the cross, and then they'll unload into that, knowing that the retail traders that love this indicator will pay anything for this offload. Like they'll see it as prices, if you're long, you'll see it as price going up, right? So we're exiting, so we're getting the most advantageous exit. And you will see this surge of volume, which is a combination of retail entries off MACD crossovers and institutional exits off MACD crossover. If you look at an indicator like time segmented volume that attempts to track the weighting of the larger lots, that will be negative while the price is going up. That means that the larger lots are exiting into this run. And you got to ask yourself why. So don't use that. Don't participate. Don't be part of this. Don't be part of this outcome. Steer clear of it. There are better indicators. I'll share them with you today, but stop using MACD if you're using it now.
There you have it. I mean, that is one, Ryan, that, when I started trading, you see everywhere. MACD, people use, I see some of these gurus and stuff on Twitter, their whole handles would be about MACD, the MACD trader, stuff like this. So that's good to know from the professional side, from your experience, that, that's kind of one to shy away from. Are there different indicators useful for different markets, products, or timeframes?
Yeah, absolutely. So when you're thinking about indicators, you need to think about the type of trading that you're doing. They're not all useful for everything, and the time period in which that trading is conducted. So if you're talking about momentum or swing trading, Those are usually a different series of indicators with different settings and viewing a different chart timescale than, let's say, position trading. So momentum or swing trading would be defined as like close to close, up to about 8 days, couple weeks, something like that. Position trading is like the 3 to 6 month time frame. Like you're in for big runs, big moves, post earnings, all of that stuff, big announcements. And so you're looking at different time frames. You're using different indicators to confirm what you think you're seeing. And then in terms of products, you cannot, there's no indicator that functions on ETPs, like exchange traded products, ETFs, ETNs. You can't use indicators on that because what you're seeing as the change in price is the change in the underlying basket of derivatives. It is unrelated to the buying and selling. You can't bid up an ETF. It's just not possible unless the entire underlying landscape is being bid up. So you can use like volume and you can look at your candlestick chart, but RSI, stochastics, TSV, money stream, detrended price oscillate, I don't care what it is, it's not going to function on ETFs. They just don't work the same way. So you can't use them to trade that.
There you go. I mean, that's actually very, I feel like useful information to know that, a lot of these indicators, you might not use them for every single situation, every single time frame. Speaking of time frames, Ryan, I guess let's start with some indicators. Let's start with, how about we start with some swing trading indicators? What are your favorite indicators for swing trading? So something maybe someone's looking at holding for, a few days or a week, but maybe not necessarily a short-term trade or a long-term investment.
Right. So for the stock analysis part, I would be using, I think we have a slide for this. Yeah. Is that the one? That's the one, I think.
Yep.
So I use a daily candlestick chart. The ratio of the X and Y axis on the daily candlestick chart, as we discussed in the last episode, follows the golden ratio. So that I look at an 8-month view. So that's what this is. And then you would always have volume bars underneath it, and always with an exponential moving average for swing trading, 25. So it's the average number of monthly trading days plus a couple. So that you can see the changes. It's always important. You'll notice I generally run a moving average on these things, exponential moving average. It just makes visualization of the trend a little easier. If your volume bars are below that exponential moving average, it's weak volume. You see a big run up on low volume, that's dangerous. And then under that, and I've picked a platform here, TC2000, because it's accessible by everybody. And they've got an indicator called time segmented volume. You can write your own version of this if you use a charting package that allows PCF formulas, but it comes baked in with TC2000, and that's the time pressure at price is the best way to describe that. And then for swing trading, I'm using a period of 18, exponential moving average of 12. And that's the relationship of the time compressed large lots to small lots. And important to just take a minute and say, when we're talking about these, bear in mind that settings for indicators are always the period of the chart that you're looking at. So if it's 18 and you're looking at a daily chart, it's 18 days, it's 12 days, it's 25 days. If we switch to a 5-minute chart or a 3-minute chart, it's 18 of whatever increment you're looking at. 1 minute, it's 18 minutes. Weeks, it's 18 weeks. So these will change, and they're more or less useful. But these are settings that I've found useful. And so the next we were running RSI, relative strength indicator, and I use a combination that was taught to me by the great and legendary charter market technician Martha Stokes. So instead of a short period RSI over a moving average, which is normally what you'll find with Wilder's basic RSI, She runs a short-term RSI and then uses as the visualization aid the longer-term RSI. So in this case, it's RSI 15 over RSI 75. So you're literally looking at the strength of the price action on the short-term trend over the strength of the price action on the long-term trend. And then I set my oversold and overbought to 30 and 70. 80 and 20 used to be sort of a conventional wisdom for those settings. I find it's just way too forgiving. You know, you can have something cavitate back and forth between 30 and 70 that never touches overbought or oversold. That's clearly overbought or oversold otherwise. And then finally, you know, in terms of a price oscillator, you can use the stochastic, and the settings that I would use for swing trading would be period of 18 and then percent K6, percent D6. Anything tighter than that on the percent K and percent D is just going to create a lot of extra noise. You can screw around with those settings and see what I mean. It'll get jittery, and the two periods will cross over a lot and not be very meaningful. So if you look at the indicators on the whole, you have price at the top, that's your candlestick chart. And then you're looking at daily aggregate volume, right? Total daily volume. And the red and green just tell you whether it closed up or closed down. That doesn't tell you whether everyone was buying or selling. In terms of large lot, then TSV helps you with that. That's a quality of volume indicator. And if you've heard me talk before, you know the volume is everything. And then you have two price indicators. You've got RSI over RSI, and you have stochastics. So really, you have a well-rounded group of indicators that are helping you see what's really happening in moves up and down. So if you have a lurching move up, where TSV is trending down, you know it's a retail run. You know that institutions are offloading into it. You know that it's unstable. I'm not saying don't do it. I'm saying know what you're getting into when that happens. But like you can see in this example that even though, and I forget, when did I take this chart snapshot? It might have been late last week. But in this example, like you can see that even though AMD's run is still running up on the price chart, that you're getting lower volume and the time segmented volume is crossing under that exponential moving average, which again, that's not like sell. That's not an indicator you can trade off of, but it's showing you that the large lot interest in this run up has basically gone sideways while the price has continued going up. And that's an indication of some rotation. That's institutional profit taking while retail and small funds are chasing. And you know, they don't have access to the same price controlling systems. So they're just going to trade lit and they're going to pump the stock price up. So here, you know, you see a lot of indication here that this run would probably not be the greatest time to say, hey, FOMO, I think I'm going to buy AMD. Just my opinion on that. And then I think we've got, do we have what's the next slide, Aaron? Do we have one that's, yeah, okay. So we can look at here some of the pros and cons of, you know, or the positives and negatives this indicator stack is showing. So like I've set up these lines, green for it's a positive sign, red for it's not a positive sign. And you've got, you know, and this is in terms of crossover. So, you know, your first run out of the bottom for AMD, and these are actually positions that we traded. So I've got our ins and outs here, and the percent next to it that it was closed at. So you have like the initial entry point. You have like time segmented volume is over the midpoint of the indicator and it's over its moving average. You have big green volume, which is good on the volume chart. I really didn't care about the candlestick at all. There's not a tradable pattern there, although the big run-up candle isn't a bad thing. You have the short-term trend now overtaking the long-term trend in terms of strength on price. And you can see that in this case, like stochastics actually led a little bit. You know, so there's it's possible to grab that earlier, but I wouldn't have been all in without confirmation across like other indicators there. Okay, and then the next series of green lines in terms of an exit, right? You now have the introduction of big red volume bars. You now have an oversold condition in short-term RSI, and you have a retracement of short-term RSI. You have the stochastics periodization cross. So if you were looking for where to bail, it's not a terrible time to bail. It's not like these things can't jitter, go sideways, and then continue up. But this is all about sort of safe bets. And when you line up these indicators, you will see that the more risk tolerance you have, yeah, it's possible to get in earlier by waiting until you have confirmation across a number of different areas. You're going to get in later. The run will be shorter, but I think the first run was like 34-ish%. So like that's not a bad run. Now, the red lines that start lining up here are an indication of like what not to do. So if you look at this, you don't have strong strong price indication on the candlestick chart. You have a lot of indecision, you have some cavitation, you have big red volume. Okay, that's not a great place for you to line up for another run to the upside. And then you have, okay, you don't have terrible TSV here above the midpoint. It's light, it's sort of sideways. RSI is not great. You don't have short-term trend over the strength of the long-term trend. And, you've got, sort of an early, maybe kind of sort of set up for a cross on stochastics. If you had bought that and timed it exactly right, you might have eked out a few percent, but you'd probably get whipsawed, as you could see in the price action that followed. And then the next sort of opportunity that you had here on the long side is the setup at the end of the chart, where you have a strong confirmation on a number of levels. So you have the candlestick pattern, which is your, okay, that looks good to me. You have big green volume. You have large lot interest. It was a little shorter in time span, and there was less of it than the previous run. And then you've got the RSI short-term trend taking back over from the long-term trend, but not extreme oversold right off the bat. And you have your stochastics crossover. So this is a way that you can use indicators. Again, I would not, like, these entries and exits weren't these things lined up. We went go. You will do lots of other analysis. I'm sure you all do. I'm sure that you do external analysis. I'm sure you read analyst reports. I mean, we're a quant and AI firm, so we really don't care about the fundamentals. But these types of things line up for us and confirm what we've seen elsewhere and assist the traders with entries and exits. So that's an example here of some fairly reasonable, conservative swing indicators that you can try out yourself and see if they're meaningful for your type of trading. They may not be. You may find like a price rate of change is more useful to you. If you trade just compressions, maybe Bollinger Bands is useful to you. I personally don't use them, but you can try them for your trading style.
Yeah.
Yeah.
One thing I'm curious about, Ryan, with these indicators, and specifically with the the volume, and we're looking the volume bar here. This is hold on, I don't think you guys can see my cursor on here actually, but it's the green and red bars right below the line under where it says AMD. I always have the volume bars up when I'm trading, and I always that's like not the main indicator I'm using, but like always this one that I have no matter what other indicators I have on. But I honestly don't even really know a lot of the times what I'm looking for in terms of, just because I think when I first started trading, I assumed, okay, high trading volume means there's a lot of buzz around this stock. That's got to be good for this stock. When in reality, I think a lot of times you see the highest volume bars are on days where the stock's selling off. And then sometimes you'll see stocks perform really well on days where the volume's not as high. I guess, why is that? And what are the takeaways you're looking for when you are looking at these, volume profiles?
Well, if you want a quality trend, you're looking for strong, continuous volume above the moving average, right? Like it is a strong sentiment if you see that. If you don't see that, then you're asking yourself what's causing the move. So and usually that is liquidity pockets and voids, what we call liquidity pockets and voids. What the hell is that? It's an illiquid stock. You can check that for yourself on the minute scale. If you see, like on your charting software, a bunch of dashes, like it hasn't printed in a minute. If you see dashes on the 5-minute scale, like forget it. That thing, like 5 minutes was like an ice age for us, like not a print. No one printed it in 5 minutes, not a single trade. Okay, so what will happen is that the spread will be enormously wide. And then somebody comes in and starts printing it with an at market order, while the NBBO lets the market maker fill it from inventory at the offer. So if it's sort of quoting, or last print was near the bid, or it's quoting around the mid, and you get permission to ram this thing in at the offer, they're going to do it. So then the whole spread will jump up and bracket around or sit at that new offer. And you get price printing up and up and up and up on not a lot of volume. It's because it's an illiquid stock and people are giving the market maker permission to print high. And the same thing on the downside. Like if you have a big spread and somebody's printing at the bid, or you're able to drive it into a bunch of stop losses, which are all market orders anyway, and it starts printing down at the bid and you have this liquidity collapse, it doesn't take a lot of volume to collapse the stock price down. So if you see that, the quality of the trend, in my opinion, is in question. Like low volume, heavy price movement, who's moving that? It's either a liquid or you have small lots willing to overpay for it. And that's where TSV comes in handy, because that's going to show you where the big lots are setting up. You see an upward trend with strong TSV. It's over a moving average. It's over the midpoint. There's institutional money flowing into that. Okay, so it's not a guarantee. Remember, institutions quite often invest for the extreme term. So they may simply have a corridor that they're willing to buy in, and they don't care if the thing retraces 15% 3 weeks later, because they're looking at a 45% raise over the next 18 months. So, not a guarantee, but it's a good sign. So that's really what I would say. Same thing, so short, I spent a lot of my career shorting. Same thing, like heavy red above moving average, volume. You've got TSV like scaling down and running for the frickin' door. Like that short's probably going to light up for you. So it's not guaranteed, but you got momentum there with that. You have like crappy low red volume TSVs like neutral. They don't really care about it. You have some short-term panic and profit taking. You could get your ass whooped by the next morning in a turnaround. So
100%.
that's where volume bars come in, I think.
Yeah, that makes a lot of sense. Thank you for helping clear that up. I'm definitely gonna use some of those insights in my trading going forward when I'm looking at these things, because like I said, I'm looking at the volume and all the time, but I never really know what my takeaway should be. I think it's just nice to know a lot of the times if it's a high volume day or not. Ryan, what's different about position trading indicators compared to some of the ones that we've talked about?
So position trading indicators, you have a longer horizon outlook, right? So, and I think, we've got NVIDIA here, we decided to use chip manufacturers today. So with position trading, you're usually looking at a weekly chart, because your time frame is like 3 to 6 months. I think it's a big difference between a retail trader and a retail investor. So if you're on this time frame, you self-direct part or all of your portfolio, your family's portfolio, you're a retail investor. So you're not looking at intraday or daily rebalancing and adjustments. You're checking in on the weekend. You're spending a couple of hours on a Sunday going through your list, checking your positions. And you've got embedded order controls, probably good till cancel profit taker. You definitely would have a stop loss. So you don't really need to look at this stuff during the day, because it's not moving in increments that are going to trip up after the open, unless it's like a huge earnings day or something like that. And so the indicators using, some of them are same, some of them are different. The periods definitely change, remembering that we're looking at periods. So I use a weekly candlestick chart. It's exactly the same aspect ratio. I use the same volume chart with an exponential moving average 25. But remember, now we're looking at 25 weeks, not 25 days. So you're looking at like the exponential moving average of volume over the past 6 months. And then whether it's something, okay, so I've put here, Worden has something called Money Stream. Your software might have something called Money Flow. There are a lot of flow of funds indicators. And that's not a price indicator. That's a quality of volume indicator over time, large lot, in and out, and it's cumulative. So for this, I picked Money Stream with an exponential moving average of 52. So we're looking at 52 weeks. So the blue line there is the average flow of funds, exponential moving average flow of funds for the past year, and then the flow of funds on the weekly scale. And like you can see that actually Money Stream is a little leading when it comes to this. Like you're getting some key takeaways from that in terms of your management. I do use TSV for position time frame, but then you're looking at 26, and I'm looking at an exponential moving average of 12. So I'm looking at the large lot accumulation or distribution, the time compression on like a 6-month time frame versus a 3-month moving average. And so you can play around with these settings to give it the sensitivity that you like. Too low and it won't be meaningful. You get a couple of crosses to highlight behavior, and too sensitive and they'll just constantly wiggle back and forth. You can't read anything off that. I use RSI over RSI again, but again, I change the periods here. So the short-term RSI is 12. So that's like the quarter price strength, and RSI, the long-term, I use 52. So 52 weeks. So that's the year. It's the quarter. It's the strength of price for the quarter over the strength of price for the year. And then a lot of these charting packages have the institutional tracking tools, which like basically almost no retail traders or investors use. And they're pretty useful. And this is one that Worden has, which comes from Morningstar, and it's called percent shares held by institutions, or PSHI as we call it. And it's important to bear in mind that this is always in arrears, right? Like institutions report the changes in their ownership on a monthly or quarterly basis in arrears. So when you're seeing this accumulation or distribution in terms of the percent shares held by institutions, you're seeing it one period late. Like each block you can see here is like 1 month late. So that's just an important thing that we can qualify. And how these work in determining like, when you may want to take a position, when you may want to be cautious. I think we highlighted in the next slide, which is just,
go ahead and
I kind of blocked out some periods where you can see like the distribution that's occurring, right? So like, what's the change here? You have like flow of funds on Money Stream is consistently up through NVIDIA's weekly run up. And you have sort of obviously mixed green and red volume, because you're going to have profit taking. You're going to have sector rotation. You're going to have position rotation. It's not that there's anything necessarily wrong with NVIDIA during that first sort of third of the chart, or 40%. But you have objectives that are met, and then you have obviously investment management and risk committees that are like, yeah, we think this is getting hot. We need you to de-risk over here because we're going to allocate just across SMH. Maybe it's a more distributed outlook, who knows. And you've got sort of that waving but declining over weekly time segmented volume. So large lots are like always in early, and then over the course of that sort of beginning 40%, you're starting to see the distribution, but you're still above like that zero barrier middle line. And here you can see that the strength of trend is cavitating all the way around that 52-week moving average. So for me, I don't find that useful. Like, I thought that was a good example of what can you take away from that? Nothing. That indicator is not functioning in that period. And you are seeing the percent shares held by institutions, with one small example, declining. So there's distribution that's happening during that period. And then what's the end result? So you have that peak, and then you have like heavy red volume, flow of funds just starts dropping rapidly. TSV craters essentially. Those are the large lots exiting. Now you have a decoupling of RSI over RSI, and confirmed as the reports that there was distribution by the institutions showing up in PSHI through that whole period. And then again, you have a recalibration, you have strong green volume, you have flow of funds returning, you have TSV moving back up, showing that the time compression of the large lots is now indicating the presence of institutions. RSI, yeah, fine, it blows up into like an extreme oversold condition, but it's a healthy. And then you have this last section here with PSHI. You have, okay, some are reporting that they've accumulated again. What could you infer from this? That you have fewer institutions and probably more retail and small funds holding this during this run up. But you also probably have a lot of ultra high net worth and high net worth individuals. Like, it's important to remember that there's something crazy like 10,000 people with over $10 million of net worth in the world, and thousands of billionaires now. And these people have enough money to move markets, but they don't show up as institutions. A lot of them are family office, they're avoiding regulation, so they're not going to appear on that lower chart, but they have the volume to throw at this and move price aggressively and show up in large flow of funds and indicators like TSV. And then I think I included like one more chart on this just to show kind of so it's like, and then you have like the disuniting of these indicators. So if you were just looking at price, it's like, yeah, this is bad if you're long. It's good if you're short, but it's bad if you're long and good and then good if you're long. But is that necessarily the case? In the first one, yeah, like the first block of area charts that I put up here or rectangles, everything confirms everything else. But then the next section, you have some confirmations and some not. So for that original run up, you have an advantageous chart pattern, you have good strong green volume, you have the introduction of new money flowing back in, and you have large lot compression, you have good RSI profile, despite the fact it being a bit overbought. But then you have this really neutral percent shares held by institutions. Are they not there? Or is it a swap? So you have some institutions, like the smaller ones, are finally bailing out because they've taken their licks, and you have new ones coming in, or do you not have them? Unfortunately, you're not going to be able to determine that. And then the second half of this, with the price cavitation at the top, well, maybe that's setting up as a platform for another move upwards. You could read it that way, but volume's telling you what's happening in that period, right? And you can see it, and the flow of funds is starting to round over. TSV leads here, like across that horizontal platform, you have compressed large lots leaving. And that's a signature of institutional transacting in a stock like this. Like, they will leave when other people are setting up. They don't want to leave and crush the whole stock. They want to quietly rotate out while you don't know. That's confirmed by RSI. And then PSHI, again, neutral. So that's just that's it for charts for today. And that's sort of a discussion of how you might use these to confirm or deny what you're seeing otherwise. Like, if you think that there is a news announcement that's going to be favorably received by institutions, you think that giant funds are going to come flowing into this stock and start supporting it, go look at these indicators and see if you see their footprints there. If you don't see them, they're not there. And if you think that you can't see them because they're trading unlit, all of that post to consolidated tape at between 4:30 and 8 o'clock at night anyway. And so that unlit data is showing up after the fact in these indicators. You can hide it during the day, but you can't hide it permanently. It doesn't work that way. So that's a crash course in some beginning trading indicators that might help your visualization of opportunity.
Yeah, that's been a ton of information this episode, Ryan. I mean, I probably have to. It's been very informative, a lot of info every episode, but this one I think might be the most jam packed. I've learned a lot personally because some of these indicators I've been using but didn't really know maybe exactly how to use them properly, or you give some extra tips on them. But I'm gonna go back and watch some of these certain things again just to make sure that I'm using all of them correctly, because I think if you're not using these indicators in the right manner, you're like a handyman showing up to a job without the right tools, right? Like you're not putting yourself in a great position for success.
Well, exactly. Like if you don't know what you're looking at or what this indicator is designed to expose, I mean, you can look up any of these indicators. Like you can, Wells Wilder wrote a bunch of different indicators. RSI is maybe the most famous, but he wrote an iteration of stochastics. You can look up what it was designed to do. You can usually get the formula for it. You can conduct your own evaluation. You can test different periods. You can test different moving averages. Just never use a simple moving average. That's useless. You can choose to use exponential front weighted, or in some circumstances, like maybe price rate of change, you might choose Hull. But otherwise, like there is no, this is what we all use, or this is what you have to use. This is what I used and other equity traders that I worked with used. But I mean, like PROC, which is price rate of change, or VROC, which is volatility rate of change, something that a lot of traders that I worked with used, and I was never any good at it, honestly. Like I completely understood what it was for. Its periods were always super short and it cavitated a ton. And I had a hard time finding anything meaningful with it. But there were other guys that really struggled with like any kind of volume pressure at price, like TSV. And they lived off of price rate of change. Nobody's right. Nobody's wrong there. It's whatever works for you and helps you see what you're trying to look for. But again, it's important for you to know what this is, right? Like RSI is not going to show you volume. It doesn't even use volume as a criteria. You are looking at straight strength of price, short-term over long-term trend. If you're using that indicator, volume isn't going to show you price other than the time or the pressure of volume at specific prices, specifically weighted towards large lots. And then I guess the last thing I'd say, Aaron, is be cautious. There are some indicators out there. Worden has one actually that I've had sort of like a 15-year problem with, and it's called balance of power. And it's a really great idea. And it's supposed to be the large lot buying versus selling. I mean, like, can you imagine a cooler indicator to find quiet accumulation? You get these green, gray, green, gray, green, gray bars. That's quiet accumulation. You get red, gray, red, gray, red, gray. That's quiet distribution. And then when you get heavy green, heavy red, that's institutional accumulation, heavy, lit, or distribution. Only the problem is that, a bunch of us dug into this years ago and sort of challenged Worden a bit because the shorter time frames didn't add up to the aggregate volume of the longer time frames. So if you had like a red daily bar and then you went down to the 5-minute and added all up, you could get a green daily bar, which really shouldn't be possible. And we never got a very good explanation of why that was. We got two different explanations. It's extremely complicated. The algorithm or the indicator is 4 pages of calculations. Not so sure. And then a representative said, actually, it just uses, I forget what the explanation was, but it made no sense. So that had a lot of promise. We ended up building our own ultimately because we pipe real-time data from ICE, but we couldn't get it from that. So be skeptical, drill down. Any of these proprietary indicators, they might be good, but make sure you work through them and understand what they're trying to do and that they actually do what they say they're doing.
100%. Well, Ryan, we've been going for about 45 minutes now. Again, just a ton of information. I'm going to hop in here after and probably chapter it up a little bit so people, we can really see. I think it's time for our Kaiju kicker. So let's go ahead and I'll get a little bumper for that. So let's play the Kaiju kicker, cool video bumper. And when we come back from that, I'll pull up the kicker on the screen and we'll look at our biggest takeaways of the day for everyone tuned in. All right, so we are looking at. You wanted to walk us through these do's and don'ts, Ryan, real quick?
Sure, absolutely. Okay, so use the indicators that match your trading style. Percent shares held by institutions is not going to help you as a swing trader, and longer term periods are not going to help you, as well as like money streams useless for swing or momentum trading. Don't bother. Do mix price, quantity, and quality indicators. Really, really important. If you are looking at only one of these, if you use Bollinger Bands, price, RSI, price, candlestick chart, price, stochastics, price, you got nothing other than volume bars that's showing you the quantity or quality of volume. And man, volume is everything. Please don't use MACD. That's just a train wreck waiting to happen. If not today, if not tomorrow, just trust me, not a single professional trader I have ever met in my entire career uses that. Do not pay more attention to price than volume. I kind of said that already. So just for the cheap seats, volume is what's driving the price, good or bad. And do not trade off indicators alone. So I know I highlighted like a series of confirmation crossovers, and you might feel like, hey, if these things line up, I think I can trade off of them. I'm not saying that like in my early career, I never did that. I'm not saying that there aren't traders that will lean that way, but they're really supposed to confirm everything that you believe about the trade, as well as your trade plan, which we're going to talk about in a future episode. But it doesn't matter if you get a million crossovers and your trade plan shows that the asymmetrical return on risk for this trade is going to invert. And you can be like 1 to 3, don't trade it. That's it.
Well, there you have it. Thank you, Ryan, for walking us through our Kaiju kicker. Again, our biggest takeaways of today's episode. Today, we were talking about trading indicators. This is part 4 of 8. So we're about halfway through of our Kaiju educational series. Check out part 5 next week, same time. Ryan and I will be discussing one of the most critical components of a proper trading battle plan that many traders leave out: risk mitigation. So we're going to be talking about how to mitigate risk. I'm a guy, Ryan, that I think is the perfect guy to learn from you on this, as someone who's maybe blown up 1 or 2 accounts before. But maybe you'll be a better person to talk about it than I will, and I'll be the kind of person guinea pig learning from you.
Absolutely. You're going to hear a lot of us say things like it's easy to make money and it's hard to keep it, and that just boils down to risk management.
Pigs get slaughtered, right?
Yep. Absolutely. Well, God, that's a little harsh, Aaron. I mean, can we just say that risk mitigation is overlooked generally in
Okay, let's go with that. It's a little bit
trading education. Let's say that.
It's a little bit better of an outlook. All right. Well, Ryan, again, thank you for joining us today on Kaiju and Benzinga's educational series, episode 4 of 8. We'll be back same time next week. Do not go anywhere. Tuesday, 11 a.m. Eastern. Ryan, enjoy the rest of your day.